Make sure you max fund first. In this episode, I'm going to address the question, what is the best way to do a 1035 exchange on a life insurance policy? This will help you understand why many insurance agents do not do it correctly or do not maximize the benefit of exchanging one life insurance policy for a better one. My name's Doug Andrew, and I've been a financial strategist, retirement planning specialist for more than 46 years, and I've helped thousands of people determine which life insurance policies or contracts are going to be the best for them to achieve their financial goals. I was never a captive agent with any one company. I used several different companies. I usually had about 200 at my disposal, but there were generally between 6 to 12 that were my favorites that I knew would perform best, and they treated their customers well. Sometimes, unfortunately, many insurance companies will change things through the years on the older policy holders, and they make it not so attractive if you've sort of hung in there, and I thought that was wrong. And so many times I would do an audit or a comparison to see if it would behoove someone to exchange an old, outdated, non-performing life insurance policy for a better one. Now, that could have been policies that they actually had taken out through me 15 or 20 years earlier, or maybe people came to me after they read one of my books and got educated, and they wanted to exchange their life insurance policy, which maybe was designed primarily for death benefit, and they learned about how you can use an indexed universal life more for living benefits. And so they wanted to exchange a policy, a like policy, for another policy. That is provided under Section 1035 of the Internal Revenue Code. Hence, it is called a 1035 exchange. If you've ever heard of a 1031 exchange in real estate, that's where you can sell one piece of property and buy another like piece of property, and the money goes directly into the new property and you don't have to pay tax. It continues to grow tax deferred with real estate. With life insurance, it's tax free, and your money will continue to grow tax free as it moves from the old policy to the new one, but there are some very specific rules or things you need to consider if you're going to do this. So the first thing that I would strongly recommend is that with someone who's proficient, they order an in-force illustration from the insurance company that issued the existing policy that you're considering doing a replacement. You want to have an illustration so you can compare. And you want to make sure it's an apples to apples comparison. Now, many people that would come to me, they wanted to change the objective. So you have to ask yourself, when you took out this insurance policy that you're looking at replacing, what was your objective? Many times it was just for the death benefit. Now they want to change it for living benefits, and they want a policy that will provide maybe double the net spendable retirement income than their existing policy could ever generate, because it wasn't designed to do that. If you're wanting to maximum fund a policy for living benefits, here is one consideration most insurance agents do not understand. If you had an outdated universal life and it wasn't performing very well and the insurance company was only crediting 3.5% or 4%, and you could exchange it out and have a universal life that is linked to an index where you could earn more like 8, 9, or 10%, hello, that's a no-brainer. You order an in-force illustration showing what this would do, even if you maximum funded it. If you threw a bunch of money in there and you take it out to age 65 or 70, whenever you're going to retire, and then you illustrate the income that it would generate out to age 90 or 100 or age 120. And what's interesting in these comparisons, you'll see that traditional IRAs and 401ks and mutual funds, they crash and burn. They don't, because they're taxable. You want to see the net tax-free income. When you look at that, you realize, I want a better policy maybe. So then you do a 1035 exchange. So all of the years All of the money that you put into the old policy, you'll get credit for in the tax-free grandfathering. So if you were to cash in the policy, cash it out, surrender it, and then you put that money into the new policy, that is not a smart way to go because you're having to start from scratch in the new policy, and you have to fund it over a minimum of 5 years to be able to access the money tax-free under the TAMRA law that I explained in other episodes. If you want to grandfather yourself for the 2, 3, 4, 5, 10, 15 years that you paid premiums into the old policy, you do a 1035. You can just change it. Now, you can't take the money. The insurance company must send it directly to the new insurance company. You can't touch it. When you do that, that money transfers totally tax-free. Now, you want to make sure the costs of the new policy, the acquisition costs, are worth it, and then you'll make up those acquisition costs sooner than later. That's usually a no-brainer to analyze that. But here's the secret that many insurance agents do not consider. If you're looking to maximum fund it, under the IRS rules, we have TEFRA, DEFRA, and TAMRA tax citations that were passed back in 1982, 1984, and 1988. TAMRA is the one passed June 21st, 1988 that made us slow the flow because there were a lot of banks and brokerage firms that were whining back then. We can't compete with these maximum funded insurance policies. They pay higher interest, they're tax-free, they blossom when you die, and on and on and on. So we don't want to kill them. Why? Because this is where they put some of their money, okay? They wanted to slow the flow of money out of their institutions because back before 1988, if I had a client that had a huge lump sum, let's say $500,000. I had many clients in the 1980s that could throw in $500,000 before 1988. They were earning 11, netting 10%, and they immediately started taking $50,000 a year of tax-free income, 10% of $500,000. After 1988, you couldn't do that. If you had a lump sum and you threw it in the policy and you took the least amount of insurance the IRS would let you get away with under TEFRA and DEFRA, it would grow tax deferred. But if you started taking income, it would be taxable LIFO, like an annuity, last in, first out. The last money you're earning, the interest every year is the first money coming out. Now, when you died, it would transfer tax-free, the remainder. But if you want tax-free income, TAMRA said you have to spread it out, if it's universal life, over usually about 5 years. To be exact, if you put in $100,000 of the $500,000 the first day of the first year, you can put in the last $100,000 on the first day of the 5th year, which is technically 4 years and 1 day later. If you do that, 100,000, the next year another 100, 100, 100, 100, you don't have to put that much in. Then you can take out tax-free income the rest of your life. That's called the TAMRA rule. What does that have to do with this concept? If your old policy has already had 5 years, those 5 years of water under the bridge, you don't have to wait 5 years again. You can maximum fund, you could put in the money in one fell swoop into the old policy, which isn't going to perform well. You don't want to leave it there, but you can maximum fund it if you have someone who understands how to get those numbers. You could throw in a big lump sum of money into the old policy and then do a 1035 exchange immediately into the new policy once it's approved. You have to wait till the new one's approved. And when you do that, now you've had all those 5 years of water under the bridge taken care of. You hit the ground running, and any other room you made, you can then put in that money according to the TAMRA guidelines. If you don't do what I just said, you may have to start all over with the 5-year waiting period because you didn't maximum fund the policy before you did the 1035 exchange. That is what many agents do not understand. So if you have an older policy that's underperforming and you want to consider replacing it with a new, better one, make sure you have an in-force illustration, you have a proper comparison, and then if it makes sense to do it, you do it correctly and you maximum fund it perhaps before you do the exchange if that's your objective for the new policy. So the takeaway here is to be careful, but consider doing an audit regularly on your insurance policies to see if it behooves you to do a 1035 exchange. But I would recommend that you look at the best way to do that and do it properly. I prefer a maximum funded indexed universal life, which I affectionately call the laser fund, because laser means liquid asset safely earning returns. And so this is my 11th book on this topic, how to diversify and create the foundation for a tax-free retirement, where every $1 million can generate $100,000 a year of tax-free income for as long as you live. I would love to gift you free a copy of this book. It's a 300-page book comprised of charts and graphs and explanations. On this side of the book is actually 12 chapters with 62 actual client stories. And so if you go to laserfund.com and pay $5.95 shipping and handling, I'll pay for the book. And you'll also have options to get the audio version or some video training, whatever you would like. But start out by learning this for yourself and consider if this is a better way for you to go.